This is Fintech Insider News. This week, Klarna partners with JP Morgan ahead of much anticipated IPO. Robinhood launches trading options in the UK, and love might be in the air, but please don't fall for a romance scam. We'll be discussing all of this and more on today's show, so please don't go anywhere.
On a recent Insights episode of Fintech Insider, we discussed the collaboration between finance and other departments, and we weren't the only ones talking about it. Plio's latest finance and business synergy report dives deep into these challenges and how businesses can overcome them. With 66% of UK finance leaders saying they would have made better spending decisions if they had greater collaboration, it's clear that breaking down silos is key to success. The report highlights why 79% of UK businesses believe you have to spend money to make money, and how the right digital tools can help make that spending smarter. This report will give you even more insights and strategies to take back to your team. So download the Finance and Business Synergy Report today at plio.io/11FS to learn how better collaboration shapes better business.
It's back. The 2025 edition of our annual Pulse Report, where we unveil and break down the best user experience financial services has to offer, is out now. Our experts have been busy researching and analysing product experiences from every corner of financial services, from crypto to inclusive design. Find out who were named our Pulse Stars, the best of the best from 2024. Read our highlights from the state of UX in the industry. And discover the bold predictions that our experts have made for the year ahead. Visit 11fs.com/report to download your copy.
Hello and welcome to episode 937 of Fintech Insider. I'm Ross Gallagher, head of ventures at 11FS. We're recording today's episode the day before Valentine's Day, so love is in the air. Along with a few panicked faces in front of me who are probably rushing out to buy a gift as soon as we're done here. I'm not naming any names, but me. And joining us on the pod this week to help unpack the biggest fintech news, we have a really warm welcome back to the show for Veronica Glab, independent fintech consultant. Veronica, as ever, it is absolutely lovely to see you. How are you doing?
I'm very good. I honestly can't complain. I think some of my friends in the fintech community might know that I've spent the last few months traveling quite a bit, covered a lot of countries and got to be a fintech nerd in all of them. So I've just settled down and based in Lisbon at the moment and very keen to catch up with you guys.
Yeah, I love that. I really do. That's so great. And thank you for jumping on and joining us. Maybe you can sprinkle in some little, some of your favorite experiences from traveling around the world as we go through the show.
I know. It always feels like a bit of a humble brag, but I was in Indonesia, Argentina, Poland, and a couple other places over the last 5 or 6 months, which honestly, it's always a really interesting and humbling experience because you get to have a lot of really beautiful experiences, meet a lot of new people, but it's always an eye-opening experience to see how different people in different cultures interact with money and get outside of your own bubble as well.
Absolutely. There's a lot of our listeners now, along with the rest of the panel, that are very jealous. Right, next up, we have another familiar voice to regular listeners, Megan Kaywood-Cooper, founder and CEO of Kaywood. Megan, likewise, always an absolute pleasure having you on the show. Thank you so much for joining. How are you doing?
Yeah, of course. Yeah, thank you for having me. Yeah, I'm back into startup mode, but it's been really, really good. I think we really hit our stride in the early stages of build and getting momentum, which is really exciting. I feel like usually for me, January feels like it's like 3 months long at least. And this time I feel like I blinked and it's like middle of February. So yeah, it's going really, really well. Just very busy as per usual in the startup life.
Yeah, congratulations. I can imagine that it is fast-paced as anything, but yeah, great to have you with us and great to hear it's all going well. Last but certainly not least, a true OG Fintech Insider, Sarah Koscienski, CEO of Fintech Wales. Sarah, welcome back. How are things?
Thank you for having me. Always a pleasure to be back. And as discussed earlier, quite nice to be on this side of the question answering partnership. All good. Yeah. I've been saying for the last few days that if we had a night 29th of February this year. I'd be almost a year in this role. As it is, I think I have to wait another 3 years to say I've been in the role a year. But
These
yeah,
are the perils of starting a new role on a leap year.
I know. It seemed like such a good idea when I agreed to it when I looked at the contract. It seemed quite special, and now I maybe slightly regret that. But no, things are going brilliantly over here. Absolutely loving things in Wales, and I can't wait to tell you more about it as we get through the show.
Yeah, awesome. So glad to hear it. All right. Well, look, we have a panel, a quite frankly amazing panel, if I do say so. So now let's jump into the news. Now, our top story this week comes from Fintech Finance with the headline, Klarna signs with JP Morgan Payments to expand merchant services offering. The partnership will provide Klarna's retail partners with advanced payment solutions, including fraud prevention and data insights. The goal of the partnership is to streamline payment processes, making transactions smoother. Nice little nod to Klarna's old tagline there, and more secure for both merchants and consumers. Klarna also hit headlines for another reason earlier this week, as their CEO teased the news that the company is ready to embrace crypto ahead of an anticipated IPO in April. Sarah, I'll come to you. I'll come to you first on this. I mean, lots of interesting activity building up to a potential IPO. It's always going to grab headlines, isn't it?
Oh yeah, absolutely, and particularly in the the current market, or shall we say the recent market. The fact that anybody's even confirmed that they're willing to go to an IPO is actually newsworthy. I think Klarna's going to be, it makes sense for it to be one of the first ones to go. I think it's going to be really interesting to see how it performs. And as you say, leading up to it, so there were some really interesting sets of news that have come out about it. I think the JP Morgan partnership's a really interesting one. I'm always intrigued when this kind of partnership are announced. Kind of the partnership's great, but how many merchants are going to take it up? Like, what are the advantages to merchants of going through this new partnership rather than going to Klarna directly? Like, is it going to be cheaper now for the JPM merchants now that they're part of this network? So that's a really interesting one. Obviously, great brand association for Klarna. Wonderful going into an IPO to have JP Morgan as a partner. Really, really good for them. Really, really good headlines. Me being me, I'll want to dig down into the numbers a little bit later on and kind of see how that partnership is going. And then, CEO of Klarna, never one for kind of... he knows how to get a headline, shall we say, sort of, what was the tease? They're going to embrace crypto. Quite what embracing crypto means at this point, nobody is quite sure. But yeah, the one thing you can say for him is he's absolutely guaranteed to get that front page on any of the fintech and broader tech press with his quotes. So yeah, I think really interesting. The most exciting thing there for me is to watch the IPO, see what happens. And I think almost every other large fintech company that's been kind of holding back over the last couple of years will equally be waiting with bated breath. And to be quite frank, we'll be quite pleased that Klarna's taken the plunge first, so they don't have to be the first.
Yeah, it's a really good point. And I mean, there's lots of talk about IPO, as you say. People being generally pretty coy. There's people that see it as the next natural step. I know T.S. O'Neill was sort of quoted along those lines recently, and then others that are kind of looking at potentially different routes for capital, whether it's secondary share sales, etc. But Megan, what sort of grabbed you when you saw this story among all of the very interesting sort of subplots, I suppose?
Yeah, absolutely. I've been watching Klarna and their performance over recent years. And I think when you look at the revenue they're driving and how they're acquiring customers, I think the BNPL product that they offer has just been received so well by the market that it makes sense that they would be the one that would be well positioned to IPO. And then with the JP Morgan side of it, I think the world's largest merchant acquirer. They do 2 trillion in transactions. They have over 900,000 businesses on that platform. From an investor perspective, one of the key things they always want to know about is your cost of customer acquisition. And I think when you're looking at the continued scale of Klarna, they've done phenomenally well so far, but continuing to expand through the market. I would say the JP Morgan partnership is a really good signal that they can continue that momentum forward and they can continue bringing on significant numbers of new customers onto that platform through that partnership. So I think it really makes a lot of sense that he timed this particular partnership announcement alongside the IPO as well. And it doesn't hurt, as Sarah mentioned, to, throw out crypto and it's like, and something in crypto, because they're already an AI-powered global payments network. So they already have AI in there. So now AI and crypto and JP Morgan, and they have the trifecta, like the holy trinity of like fintech words for an IPO. It's great.
I think I was going to try and keep the crypto piece till last because it is quite vague, but I think we sort of keep touching on it. I mean, Veronica, it is vague, isn't it? Like, we're going to embrace crypto. I mean, it could mean anything.
Yeah, I mean, it's a very cluttered headline. If for fintech nerds, if I may, guys, if four fintech nerds can't even piece it apart and see which part is the leading part of the story, that's not necessarily like a great sign, about how strategic of a direction that will go in. Is that just jumping on the bandwagon? Is that just, trying to prime their valuation pre-IPO? But I do think it is, I hesitate to say the word symptomatic, but I do think it's indicative of where crypto and blockchain will go more broadly in the US, but also more globally as well. It does seem like you can't really talk about IPO, you can't really talk about regulation, you can't talk about liquidity without talking about crypto, without talking about institutional adoption of crypto. What is actually interesting to me, though, is, Klarna as a buy now, pay later, it is fundamentally a consumer product. What I would personally be really interested to see is if this enhances any sort of like consumer adoption of crypto as a valid form of currency for making transactions and purchases. That would definitely be a first for the US for sure, but for a lot of international markets.
Yeah, no, I completely agree. I mean, it's all going to come down to, like, as ever, like devil's in the detail. What are we actually talking about here? It's hard to take a position when, it's a posting on X that says we're going to embrace crypto. But Sarah, I think it comes back a little bit to what you said at the top of this story about knowing how to grab a headline. Crypto is very much, again, sort of like front of mind for people, sort of on trend in terms of that hype cycle. How much do you think this really is just about like sort of headline grabbing versus where we go from here?
Yeah, I mean, I think you have to sort of remember, and I think a lot of people forget that. I'm sure nobody around this table, this virtual table, as it were, forgets that Klarna is a regulated bank in quite a lot of places. And so its ability to play with crypto will be somewhat limited, or rather what and where it plays with crypto will be somewhat limited by the fact it is a regulated bank and a licensed bank. And I think that's what's interesting as well, that people forget that in Europe, a significant part of its revenue comes from its banking operations as opposed to its kind of buy now, pay later operations. So it also takes me back to the AI headline, and forgive me, I can't remember it exactly, but when it was announced, it was something along the lines of, we're going to halve our workforce because AI is replacing the people. And those of us who kind of watch the industry go, yeah, okay, good headline, clever. And they were one of the earliest adopters of enterprise, ChatGPT enterprise. But also, did you overhire during that crazy growth period that we had, 2021? And this is a really good and a really clever way of kind of rolling back on that when everybody else is being accused of having layoffs. So I think, albeit, that was quite a long way of saying they've got brilliant marketing and they are absolutely wonderful at positioning themselves. And I don't think that's a bad thing. I think it's just very, very clever. And to the points that, my learned colleagues have made, when you're going in for an IPO, positioning is at least half the battle.
Yeah. And bringing it back to that IPO point, I mean, it is, for some reason, I don't know if it's necessarily contentious. Does it feel, Megan, this is like a really, really unfair question, so I apologize. But it feels like it's almost like split down quite diverse lines in terms of, like I said at the top of the call, people that see that as the next natural step and we're going to IPO because big companies IPO and that's what they do. And then maybe other organizations, maybe more founder-led organizations that sort of are like, well, actually, no, if we go public, how do we protect our culture? How do we do all of the great things that we've been doing up until now? Do we lose control? Is that a fair assessment?
Yeah, I think so. I mean, from my perspective, Starling has always been very public about their intention to eventually IPO. That's always been a part of the plan. I feel like I've heard Monzo and Revolut talk a bit less about it. I think I probably have this huge experience because when I was at Zero, they IPO'd immediately. Like the biggest thing on the books was the domain name. Like I kid you not. So it was, they were like public from day one. So I've kind of operated in a spectrum of organizations. I do think you are right though, that people do have these questions of like, what is the most strategic source of capital? Is that venture capital? Is it private equity? Is it to IPO, like to be listed in the market? And they each kind of have their own advantages and disadvantages to what those enable. I mean, obviously at Revolut, they continue to just raise these gigantic rounds, and then they do a lot of secondaries. And so people are able to become a bit liquid with their holdings, which I think is nice from the employee perspective. It seems like they're getting some good feedback to that. So there's mixed strategies that people seem to be taking. It's not a particularly active IPO market. So it's nice to see Klarna coming out with this right now. So I think it's refreshing from that side of it. I think over the past few years as well, I think to Sarah's earlier point, we saw that really strong growth period from 2020 to 2021 where, companies were growing, there was these huge valuations. And then it's been like this fintech stress test since then where venture capital has gone down. There's been a bit of a correction in the market and valuations have reduced. We've seen people like TrueLayer have to do a bit of a down round. I think Monzo as well did a down round. So there's been a few that had to kind of like reset on those really hyped up valuations. I think from my perspective, looking at the market, what's been really fun to see, which is, I guess, a bit of a side tangent, but having been at Starling, we always built with the view of operating like a bank and making money like a bank, which is we didn't want to have fees, but we had business accounts and we could do business lending. We could take money, lend it out, make money on the net interest margin. We could take those deposits because we are a fully licensed bank and invest it in gilts and bonds and things like that. Made money on the payment side of it. We had the ecosystem of APIs and the transaction API now engine to like round that out. But it set them up really well now to have, I think it was close to 900 million in net profit, which was just incredible. Because if you look at Revolut at a 40 billion market cap, they're at 1.1 billion. So they're barely above them, even though they technically have significantly more customers. And then you see on the other hand, Monzo, I think, was at like 15 million net profit. So in terms of like looking at the net profit and how that's leading into valuations and to kind of the IPO track has been a really fun thing, I think, to watch over the past few years in the challenger bank and digital banking market. But yeah, I don't think we'll see anyone else follow in their footsteps from the digital banking side in 2025 would be my prediction. But I wouldn't be surprised if they were kind of fast followers thereafter.
Yeah, it's such an interesting one. And look, I suppose at the end of the day as well, like, every business is different, right? Like it's a funding decision, and every business is going to take the decision that's right for them. But I think it's going to be a really, really interesting one to keep an eye on. And I think, Megan, as you say as well, if someone like a Klarna, who is a big recognized brand, sort of goes down this route, then will we see a few more? And I suppose it remains to be seen. All right, I am going to move us on to our next story. This one comes from Yahoo Finance with a headline: Robinhood options trading launches in the UK. So Robinhood has launched options trading for UK customers in its latest expansion of features available on its platform to investors outside of the US. Options trading has seen increasing interest from retail investors looking for alternatives to classic stock trading, though it's not widely available here in the UK. These are financial contracts which give investors the right, but importantly not the obligation, to buy or sell an investment at a predetermined price within a specific time frame. Investors typically trade options for three reasons: to hedge against a potential fall in price, to generate income from a stock that they own, or to speculate on the direction of an investment. There's more complexity as well as flexibility, it has to be said, with options trading, and investors need to know what they're doing and stay on top of any changes. As part of this launch, Robinhood customers must meet a certain level of eligibility, demonstrating, quote, sufficient experience and sufficient knowledge with an appropriateness test carried out. I really struggled through reading that, so thank you for bearing with me. Veronica, I'll come to you first on this. What was your sort of reaction to this? It's another big story.
I think it's actually very interesting, and it speaks to a couple things that are happening in sort of the UK, but also in other markets where Robinhood is planning to expand. We're approaching a very different era for, let's say, wealth and investment tech. That with the growth, particularly with the growth of social media, but also at a time where we've got a new generation of mass affluent who are becoming more and more financially literate, really learning how to take their own financial well-being into their own hands. And then at the same time, you've also got a growing population of folks who also really feel financially disenfranchised, who don't trust traditional advisors and institutions as well. And so we've seen in the UK, we've seen in Europe as well, particularly in Southern Europe, a real growth in day trading, in new investment and like self-education around crypto. And then options, it's really great that you bring that up because that's how we got into this era of meme stocks that started with GameStop. And, you know, so I do think it's really just indicative of a cultural shift, but also a demographic shift with who those investors are. So I do think it's a very interesting and probably very valuable move on the part of Robinhood because they are literally capitalizing on the zeitgeist that was already there.
Yeah, I think it's a really, really nice point that like sort of empowering people, giving them access to these types of tools. And I suppose, Sarah, the appropriateness test that they're talking about becomes quite important because it's not without risk, right?
Yeah, it's a really interesting one. I mean, who has ever got the right to determine what's appropriate for you? And it's one of the reasons why we see sort of instruments like this used a lot more widely available in places like the US than you do across the UK and Europe because of the differences in kind of regulatory structure and, you know, kind of we've got the FCA here who have a mandate to protect consumers and, you know, how far do you take that and what does that look like when you're looking at instruments like this, which are inherently complicated to understand. I mean, I've been in this industry for more years than I care to mention whilst being recorded. And I still struggle with a lot of the way these mechanisms work. So it's interesting. I completely agree with Veronica's point that there are people sitting in Europe and going, well, they've got that in the US. Why can't we have that? Maybe there are reasons that you can't have it in the UK and Europe. I think for me, it is going to be a big test of Robinhood because they know the regulators are watching them. They've already been in trouble. So they know they're being watched. They know that they're going to be really closely observed. So they're going to have to take a really quite cautious approach to this, particularly in the UK with the regulator we have here. If they get it right, though, it's kind of a step into that more sophisticated market, which we haven't really seen anybody step into that yet. So you've got, you know, quite a lot of people who your free trades and your Revoluts who are, you know, making it very, very easy to do kind of like, you know, on basic investments and stock picking and things like that. And then you go up to kind of like the higher level where that will only serve people who've got quite a high minimum investment threshold and then charge quite high fees because of that. If they can get this right, they could come in the middle and get that kind of, you know, more sophisticated investor who perhaps does have more, you know, capital to invest and also is willing to do so in, and I'm going to say this in inverted commas, which is always great for a podcast, appropriate fashion. So I think there's an opportunity there to capitalize on it. It's just going to be a case of treading really carefully from Robinhood's perspective. There's nothing to say they won't manage to do that.
It's kind of one of those, isn't it, that like, as you mentioned, if you look at some of Robinhood's big competitors in the UK, it's that like, are they not doing it and so there's a market opportunity, or are they not doing it because there is no market opportunity? I mean, when you look at...
This is a terrible idea.
Yeah. But,
I don't know.
Yeah.
Yeah.
We're going to jump in, Megan. Go.
Yeah. I think it's such an interesting point, though. I think that was this part around the sufficiency test is the part that struck me most about the article, because I think a general critique of fintech so far in the UK, in the US, kind of globally, is that the past decade, we've done a really good job of working on automating it, like making it very easy to use, make it super easy to open an account, make it really easy to access these financial services and increasingly complex financial products that the everyday consumer used to not be able to have access to. And to be fair, I think that was the right move. We're bringing, you know, the best of cloud and mobile and beautifully designed user experiences into financial services. And that's been a huge benefit to consumers. The problem is we haven't also wrapped intelligence around that. So to help people make better financial decisions. So the story in there, in the link is about, there was this boy, he's about 20 years old in the US, Alex Kearns. He was doing this options trading in the US and he mistakenly thought he was $730,000 in debt. He desperately tried to get in touch with Robinhood and they just ignored all of his input and all of his requests, and he committed suicide. And I just when it comes to customer support, when it comes to education, making it just easy to access financial products isn't enough. I mean, that's a very, very extreme example. But the thing I'm passionate about, with my current company at Kwood, is I think there's this really important opportunity we have to use the best of technology to bring education into the experience. I think financial education is important, but if it's like a 12-step masterclass that you then have to apply, it's not enough. So you need it inline, intuitively built into the product experience. So you're going through and you're figuring out how to buy and sell options or whatever it is, take out your general investment account or comparing, funds or ETFs or whatever it might be. And inline in that experience, that's where the education should be to help you really understand it and explain it. And whenever you do have those moments of crisis, being able to access the answers that you need immediately. Because I think the consequences of getting it wrong when it comes to finances is huge. When we see, banks getting it wrong and people not being able to access their money, it has massive implications on their well-being. And so I think that was really my key takeaway from this is yes, it's good. Continue making it easier to access financial products, continue to give people access to do different interesting things to invest and make the most of their money. But it's critically important we equally give them access to the right tools to understand what they're doing, what the implications of that are, when they do it, what the effect will be. If they want to then correct it later because it's not having the results they want, what are their options to continue to manage it? So, yeah.
I think that's absolutely spot on. You can have all of the complexity and everything in the instruments themselves, but to your point, actually managing that crisis for that young investor was relatively straightforward. Just being able to access someone that could explain that actually, no, you're not $730,000 in debt and this is how this works was, I think, Veronica, going back to your point at the top of the call, which again, I think was absolutely spot on, but Megan's point, I suppose, emphasizes the importance of wrapping that, the sort of the customer support and the intelligence piece around that to be able to do it effectively.
Oh, absolutely. I mean, Megan mentions this young man as an anecdote, but if you want to put stats behind it, that's not an isolated incident. Finances is the number one reason that people divorce. In the UK, after COVID, debt was the number one reason for people to commit suicide. When that becomes a statistic, that's terrifying. And there are actually some very, very cool fintechs who are really managing debt and financial well-being, specifically with a mental health angle behind it, because it has just gotten to be, it has become a statistic. It's a problem. It's a symptomatic problem of the financial ecosystem that we exist in, right? So, and Robinhood also, with their options for day trading as well, they've gotten into a lot of trouble for not having the right duty of care towards our customers. So hopefully, that is something that they've taken as a learning, that when they offer an innovative new product, there is duty of care coming towards that. And then just a final piece that I'll add in is that, with millennials and particularly Gen Z really getting a lot of their financial information from social media as well. I would be really curious to see not just how the FCA or other regulators manage the financial product part and the duty of care part, but also how are social media companies being held to account for the type of information that is being not just shared, but the financial products that are being advertised and how.
Yeah. And where does the responsibility sit there, right? And
exactly.
Does it need regulating, et cetera? But Sarah, final word to you on this. I know I said, is there a market there? And it was a little bit tongue in cheek, but I think certainly when you look at the numbers in terms of the uptake on options trading in the US, up 47% year on year, reached a year to date total of 1.2 billion contracts at the time. That kind of suggests that the market is there, but to the points that Megan and Veronica were making, getting out ahead of some of the risks and the problems that we've mentioned and getting those safeguards in place is pretty timely. It's important right now, right?
Yeah, I mean, this can't be a rush to market. This can't be everybody throw something out there because, they see there's an opportunity and we want to, make sure that we've got skin in the game. This is not something you can do easily and you can play with and you can just rush out. This is a product and a service that needs to be very, very carefully thought out. And I wouldn't be surprised if Robinhood had been working with regulators, or at least I would hope they had been engaged with regulators as they went ahead and did it because they know that they're the first people to do it. And hopefully, the regulators in the UK have always historically been open to that. People coming to them and saying, we want to innovate, but we want to do it in a way that means you're not going to fine us millions of pounds later down the road or kind of, make sure we're preventing consumer harm. So I think, I would like to think that there is an opportunity and that they are thinking sensibly about how to make the most of it, and that they can then be leaders for other people who want to offer, a wider variety of financial instruments to people who are looking to make the most of their money in an environment where interest rates are sadly starting to go down. Well, it depends which way you look at it. Depends if you've got a mortgage or not. Sadly going down, or if you've got nicer, it's brilliant. Whichever way you look at it. But yeah, it's going to be an interesting one to watch, and it's certainly going to be. They've sort of stuck their neck out by doing it first, I think.
Yeah, no, spot on. I couldn't agree more. All right, on that note, we're just going to take a quick pause, and we'll be back with you very shortly.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alika Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Average is not invited. Not if you're holding your company off-site in Las Vegas. We aren't on friendly terms with the bare minimum, and unenthusiastic is uninvited. Las Vegas's creative energy and world-class hospitality want to bring your company off-site to crazy new heights. That's why fear-based leadership is afraid of Vegas, and boring won't be there, but it will be watching the meeting recordings later. Plan for the extraordinary at vegasmeansbusiness.com.
Welcome back to the show. Now, before we return to the news, we wanted to tell you about our latest Insights show. Have you ever wondered what your finance team is really thinking? Well, we teamed up with Pleo to dive into the challenges facing modern finance departments and how businesses of all sizes can collaborate better to overcome them. It's out now. Just head to the podcast below this one to listen. Okay, back to the news. Now, our next story comes from TechCrunch with a headline: QED leads $11 million investment in Nigerian fintech Raenest. So Raenest seeks to address the issue of slow payments for remote and freelance workers in Africa working for big tech companies and startups. Often employees struggle to open accounts that accept US dollars, face slow invoicing and payment processes, and this problem is exacerbated when employers use incompatible payment platforms. As Africa's tech ecosystem booms, this is becoming a bigger and bigger issue. However, through its retail product GigPay, Raenest offers freelancers virtual USD, GBP, and Euro accounts to receive payments, manage multi-currency wallets, and convert currencies. It also provides virtual and physical debit cards that accept multiple currencies like US dollars. And last March, the company expanded its platform to streamline international remittance with a new brand, Raenest for Business. As of this week, Raenest has raised $11 million in Series A funding, led by QED investors, to expand its reach across Africa. Megan, I'll come to you first on this one. This feels like quite a targeted solution to a pretty big problem. What did you think about it?
Yeah, I mean, I wasn't familiar with them before really coming across this news headline, but I think it makes a lot of sense. Looking at what they're trying to solve within a very specific payments niche with payments acceptance in terms of the user experience and the output, that all makes sense to me. I think the part that I found really interesting about this story was that when the founders originally launched in 2022 as an employer of record, they had a completely different idea, which was around helping the foreign companies actually make these payments. And then once they started working and actually building the company, they realized that's not where the problem left. It was really on the receiving end. So I think it's a really interesting story of like a team who identifies a problem. They go out, they move quickly, they build a solution. They realize actually their hypothesis was a bit wrong. They quickly pivot. They see this other opportunity. And now they have this 160% year-over-year growth over the past 2 years. They have like over 700,000 individuals using the platform to receive payments. And so I think it's a great story of a startup who's it seems like led by some people who really understand the importance of like moving fast, learning quickly, pivoting when you need to, and then continuing to scale. And I'm quickly learning more about the venture capital landscape across the UK and Europe. And it seems like QED is very prime position in the world of fintech. So it makes sense that they would be the lead for it. So it's a great news story.
Yeah, I'm with you 100%. That was the bit that stood out for me as well. Like it's a real success story for pivoting and sort of responding to market need. You know, when you look at the $700,000 pre-seed, $2.6 million seed, 11 million in Series A, you know, their backers clearly believe that they're really onto something. What did you think, Veronica? It's an interesting one.
Yeah, it is. It is really cool. I mean, I think that first of all, their ability to pivot it is really, really clever. Because I did look into it, and if memory serves me, these are our first-time founders as well. And sometimes I think founders can get very married to their original vision. That they almost, they're married to delivering the original vision, and then you develop blind spots. But this is exactly the opposite of that, where this is an extremely scalable product as well. I mean, number one, they've chosen a niche in the employer of record space, which in the US and Europe with like deal or remote or omnipresence, pretty crowded market. So they've developed a very interesting niche there. But in solving for payments, what they're really doing is having a scalable and very, very interesting social impact. They're helping gig workers get paid. So they're already working on one of the biggest obstacles for gig workers, which is to get paid regularly for their very hard work. But they're also going through the right regulatory process to open up those channels. And wherever you can make faster, safer, more efficient payments, potentially some of those solutions might be scalable to solve for even more problems like remittances, banking in markets that are pretty traditionally very, very underpenetrated by bigger institutions. So what that means for, African payments as a whole, as a landscape, but also potentially even the business's expansion across Francophone Africa, Lusophone Africa, or even potentially into Europe. The possibilities they're really there because they've solved for a very, very big obstacle.
Yeah, and the way you describe it, it's kind of win-win-win. Like they are solving a really important pain point for the employees, the gig workers, et cetera. They're helping make these processes better for the employers. And as you say, doing that in a way where they're working closely with the regulator, it's safe, it's being delivered in the right way. So it's, yeah, you're right. I mean, it ticks lots of the boxes. And Sarah, it looks like they're getting some pretty impressive traction.
Yeah, I mean, it was interesting to me. I had to sort of read it twice and sort of think, why would freelancers be being paid from overseas? But then I went into the detail and realized that these are freelancers being employed by, global tech giants, which is interesting twofold. One, it's a really good market to target on because that these freelancers are being paid an awful lot more than, freelancers employed by other organizations in locations such as, Nigeria, which is where they're based. So kind of it's high value transactions. It may not be that many, but whatever it is they're being paid, that's a large number, and that makes it kind of easier to build your economies of scale. So I thought that was a really interesting kind of the pivot was interesting, but where they landed was even more interesting to me. That kind of it wasn't just the other end; it was the very specific other end. I feel honor bound at this point to point out that QED's co-founder Nigel Morris is Welsh, proudly Welsh. So I feel the need to just put that out there, just whilst we're in the conversation. But I just, on a serious note, it is interesting to see more and more kind of European, US investors looking at the African market. And when you look at fintech investment across the globe over 2024. Africa was almost the only region that stayed flat. And if you look at Q3, Q4 for 2024 versus Q3, Q4 to 2023, Africa was the only region that saw a significant bump up. So there is, okay, it's, the amount of money going in is much, 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 much smaller than, the UK market or the US market. But for me, it's interesting to see that investors from around the world are looking at Africa and finding these businesses. I know Africa is a huge continent. There is so much opportunity there. And so far, an awful lot of it seems to have been centered in Nigeria. But that's going to spread. And to Veronica's point, as these organizations find ways to spread across the continent and find, synergies and new markets they can tap into, much as we've seen in Latin America with companies like Nubank, I think the investment there is only really going to grow. And that's really exciting to me because it's a continent with unique problems. And within it, there are lots and lots of countries with even more unique problems. And unique problems result in unique solutions that are very, very creative and that are really, really exciting to investors. So I think this is it's one of many, and hopefully the rounds are going to get bigger and bigger as we go through the next 12 months.
And yeah, I mean, Nubank is such an interesting, I suppose, sort of case study to use in that context. And I suppose if Megan, if the investment that Sarah's talking about that we've seen recently into Africa, if that's indicative of a sort of bigger trend and what's to come, then there's potentially some exciting things on the horizon there.
I'll be honest, I think over the years, like when I've been on this particular podcast, I feel like I often end up talking about these really cool African fintech news stories. Like I think my first ever one in 2016, we talked about an M-Pesa news story and their incredible growth. And so I feel like it's one I keep coming back to, but there's quite a bit of innovation there. And I think as Sarah said, this news story in particular, I thought was interesting because, it was these freelancers, but getting these foreign payments. But it's it's Fiverr, it's Upwork. And it reminds me of, and I can't for the life of me remember her name, but it was Samasource or something like that. There was this really interesting company 10, 15 years ago that would effectively try to take small parts of digital jobs and put it into other countries where you would pay, basically another form of outsourcing, to do somewhat manual and automation tasks and things of that nature, but to try to employ more people globally and try to kind of uplift and spread wealth. And I think what I've seen is a really great side effect of the pandemic really is now that we're working more digitally, we're happy to work with people more remotely. Now there's kind of skilled people everywhere and we can collaborate on these really great platforms that have built up. I think it's, just the next wave of innovation to say okay, now this has arisen, now what's the problem? And I think for this company, they've had a really good identification of the problem with receiving the payments and how to solve that. But they also mentioned the next wave for them is new product releases and looking at how to earn, invest, and build their wealth. So they see it as this wider opportunity that we're seeing in the market of step one, make things easier to access, make the kind of existing financial services better, faster, cheaper, et cetera. But then help them to figure out how to make the most of that money. And so I think, all in all, I think it's very cool. Makes a lot of sense that it's coming out of that region.
Yeah, and it's a nice virtuous circle, isn't it? As you say, they're sort of underpinning and enabling that sort of move towards greater international collaboration, and then, as you say, sort of giving back almost. And then, Veronica, it's also interesting, I know sort of Megan, you mentioned about what's to come, but it also looks like they have ambitions for international expansion throughout the rest of Africa as well. So I don't think this will be the last that we'll hear from them.
They also mentioned banking partnerships with the UK and the US, which really makes sense. But I mean, what would be really funny to see is the US, where the payments ecosystem, particularly for gig workers, is totally broken. It would be really great to see, new innovative solutions in that.
I totally agree. I'm absolutely with you. I love that story. I think it's a really interesting one, and I look forward to seeing how that where that sort of goes from here. All right, nice. I am going to move us on to our next story. This one comes from Fintech Futures with the headline: US open banking fintech Plaid reportedly plotting potential $400 million secondary share sale. So a lot of alliteration in that headline that really got me. The fintech is reportedly working with Goldman Sachs to raise between $300 million and $400 million through a secondary share sale. This move could provide liquidity for early investors and employees looking to cash out some of their stakes. While details are not yet finalized, this follows Plaid's $425 million Series D raise in 2021, which valued the company at $13.4 billion. The trend of secondary share sales is growing. Recent examples include Revolut and Monzo. which used similar moves to boost valuations and provide liquidity. The company has also unveiled a rebrand this week designed to emphasize Plaid's role as a central infrastructure player in the fintech ecosystem, positioning itself as, quote, the fabric of financial progress. It's a very nice tagline. Sarah, what was your reaction to this story?
I think the secondary share sale is a really interesting trend that ties us back in. I mean, Veronica was saying earlier that there's a really nice thread through all the stories today that ties us back into that story about IPOs and are we seeing them and they're not coming. And, you know, what is the reason behind these organizations doing secondary share sales? And I'm sure there'll be multiple for each of the organizations that does it. You know, there's the obvious one of kind of creating liquidity. I think there's also a really interesting point perhaps to be looked at, which is rewarding loyalty of employees who have, when these organizations started and when some of us around here started, it was common to, you know, forego a bonus in favor of shares, and there was this big story that it was going to be fine, and the money you were going to get back when you sold those shares when the company exited in and we were told the story it was like 3 to 5 years was going to buy you that house. You know, okay, that's quite an exaggeration, but that was the general theme and the general story. And now I know many people who have been working in this industry for 10 plus years who are sitting on vast numbers of shares in companies that are successful and thriving, but haven't been given that reward that they were promised. So they've never got the cash bonus that, you know, that you would have done perhaps if you're working at a large bank, and they've never got to realize the value of those shares. And I wonder if perhaps one of the reasons organizations are doing this is to reward the loyalty of employees that are sticking with them. And perhaps to kind of, you know, in a somewhat turbulent environment where they are not able to go, right, we're going to give everybody a cash bonus. It's a way of keeping staff and keeping them on side as things, you know, as we move through what's potentially going to be a continued period of economic turbulence. So that was where my brain went to first, that we see more of these. And perhaps it's, as I said, there'll be a multitude of reasons they're all doing it. But that kind of rewarding loyalty and making people not feel like, oh, I'll just give up on working for a startup and I'll go and work for a large bank who's going to pay me lots of money because they want to know what AI is too. You know, it's keeping that workforce, keeping them incentivized. So that's just my initial thought with this one.
I think it's a really interesting point. I totally agree with you as well about like rewarding loyalty, retention, morale, culture, like all of those things. Like it's you can totally see the upside. Megan, I'm interested because I know you're sort of looking at this world at the moment. And those are all sort of like inward-looking drivers, everything that Sarah's just mentioned. But I guess looking outward, are we seeing an uptick in secondary share sales as well because like capital is just harder to come by through investors and private equity?
Yeah, I mean, I think there's a few reasons for it. On the one hand, you know, having started when I was like part of the founding employees at Starling, we'd always talked about an IPO, but obviously, as Sarah kind of pointed out, the market has not been good for one. So Starling openly said like, it's going to be 2022. And then they're like, maybe not in 2022. It turns out it's not a good time. And so I think everyone in the market kind of had certain timelines, but the reality is we had been in this expanding credit cycle in the economy, and we experienced natural expansions and contractions, and everyone kind of knew we were in the late stage of this expanding credit cycle, and then it contracted back. And so then there's just natural kind of economic ramifications for that. It's not a good IPO market. It's the fintech stress test. And yet at the same time, these companies have these employees who worked very hard for now a decade. You know, so if you start in your 20s, you're now mid-30s. It's a rather expensive time of life. If you're like a parent and wanting to buy a house, the cost of living for everyone has gone up exponentially over the past few years. And so it's like, I think it's part of that wanting to, you know, reward them for their work, but also give them a bit more liquidity that they've worked for, given that the original kind of strategy to manifest that didn't work out. I think, I mean, I love looking at like Revolut's secondary share sales because there's like Nikolai, and I'm not going to fault him for it. Just selling like what tens or hundreds of millions, going to Dubai like a genius. Like obviously, I would do that too. You know, I mean, as an American, it doesn't really work, but it makes sense. You know, when you start a business, it's not only financially constraining. You give up the option, like, you know, as we were saying, to go into a very high paid job with a nice bonus. You give that up and sacrifice it because you're uniquely skilled to start this financial company, you know, like Plaid, and you spend your time building it and scaling it. In Plaid's case, they had the $7 billion deal with Visa, right? That the regulator said like, nope, too much of a monopoly, you can't do it. So then their kind of liquidity option then fell through. And so I think you go through all this hard work, you climb the mountains, you do the thing, you're successful, you're a multi-billion-dollar business, but you do want to like have that translate a little bit into like positive outcomes in your life. And so I think that to me is part of what's driving it, is just like, it's the best option in the market, given the economics for them to achieve that kind of liquidity. It's also, to your point, another way from the company in terms of like the fundraising side of it as well. It makes a lot of sense. So I think it just ticks a lot of boxes for what they're looking for the company and for the employees.
Yeah. It's kind of like not the best market, as you say, recognizing that they can't keep shifting the goalposts in terms of from the employee perspective. I mean, there's lots of things at play. I mean, I guess it comes back to what we said on one of the previous stories, Veronica, about like, you know, unlocking liquidity, funding decisions. Like every business is going to make the decision that's sort of right for them. Every business is unique, and so every business is going to make a unique decision.
Yeah, exactly. I mean, it's a way also to get that liquidity for any company, really, to clean up its cap table without depending on that external investor. Because if we just look at the very basics of when you take an investment from a VC, effectively, you as a founder, you start to work for the VC because you have to give them the ROI on their investment so that they can come back to their LPs and say they also did a good job. So that starts a chain of of responsibility, right? But I think particularly for, very visionary founders who have taken their companies on through that long journey, through becoming a unicorn, through IPO. And we know that when we're talking about, Klarna and some of their peers who are on that waiting list for the IPO, we are talking about visionary founders. So when you clean up your cap table by doing a share sale, then you can do things on your own terms. It's, one less set of stakeholders that you have to please now. So it's a way for founders to also take back control.
Totally agree. Sarah, I guess we'd be remiss if we didn't just sort of touch on this, but like, where are we with open banking? Are we sort of in the weird teenage phase? Or,
oh, goodness. Ross, we haven't got time for this.
I know, I've only got 2 minutes left on this story.
I think the more interesting question is, where is the US and where is Trump at with open banking? And given his, shall we say, less than fond attitude towards the CFPB and various organizations that have been behind pushing the regulation in the US, such as open banking, I think Plaid is in a really tricky position right now. I read a really interesting interview with the founders this week, and they basically said, we got to hope for the best but plan for the worst, in terms of the regulation that they've been asking for and praying for, that kind of brings the US almost sort of not quite in line, but at least brings some regulations into the US that require kind of open APIs as a way to connect various accounts and give people access to their own data. Whether those rules will now ever actually happen, and I think Plaid, it would be fairly obvious to say Plaid had been basing a lot of its future business case on that happening. So I think the honest answer is, if the US, I don't know. I don't think anybody knows. I don't think even the people who are in charge of making the rules these days have any idea either. So I think I would just take the founders of Plaid's perspective and hope for the best and plan for the worst. If you are operating in the open banking space in the US, and you mentioned your rebrand, I wonder if that's part of that positioning, is we're a key infrastructure player, we're part of financial progress, and that those messages that will perhaps chime more broadly with the new administration than kind of democratic access to data.
Yeah, that was my first reaction to the rebrand. But thank you for summing up a really difficult thing so eloquently and so quickly. All right, now for a quick look at one more news story this week that we didn't have time to cover in full. This one comes from Finextra with a headline: Australia's AMP taps Starling tech for SMB digital bank. The new digital bank is specifically designed for small business owners, solopreneurs, and side hustlers to manage finances on the go. It was built on Starling Bank's Engine platform, a UK-based cloud-native API-driven banking system. Security and fraud prevention features include Australia's first numberless debit card and selfie-style video identity verification for secure onboarding. It also includes the popular Spaces feature from Starling Bank, virtual sub-accounts for tax, payroll, and budgeting. Megan, it says here, Ross, to share thoughts, but I'm going to defer to you on this one, if that's okay.
Yeah, excellent. Yeah, so I will say the strategy with Engine and the API strategy that they've deployed has been a part of the Starling strategy since day one. So for those of you who followed, we built out our, we when I was there, no, now more Sam Everington, but we had built out a full set of open APIs and locked up with the core product. We actually launched the API at Starling before we launched the bank. So I don't know if you guys remember this, but in March 2017, we partnered with Google to use Google Campus to have this international hackathon. We had people from all over Europe, from Australia, from India, who flew in to be part of it. It was brilliant. We were the first bank with open APIs. And then quite quickly, we realized there was so much more that we could do to expand beyond even the kind of talk that we had around open banking on PSD2 to really build the bank in such a way that we could power others with our platform. And so the first manifestation of that was really wrapping an API around our access to faster payments. So at the time, we were the 13th member to directly connect because we had the full banking license, so we could do that. So all of a sudden, we could do in a matter of weeks what it would take months and significantly higher costs to do with the incumbents just because of better tech and lower cost. But then the natural extension of that is then now Engine, which is this white labeled platform that now Salt Bank in Europe, and now we have AMP in Australia. I believe there's one other one that's been rolled off on it now. Where they're effectively powering these other banks. And it makes sense because Starling has developed this brilliant banking platform. It's has the best of modern technology, a modern microservices cloud-based architecture. It has, user experiences that they validated in the market. And so they have a lot to offer other banks who want to innovate in terms of their technology, but also have a certain standard of user experience, and they can help them get to market really fast without having to go through that same experience Starling went through. And so it also is really nice because from the Starling perspective, it makes them very, very scalable. All of a sudden, they can be present and have lots of customers globally operating on their platform under other people's banking licenses where it's not like Clearbank. They're not actually offering the banking license. Like, if you know how Clearbank powers Chip, Wealthify, they've now done the Revolut Dear, but they actually let people use their banking license at Clearbank. That's not what Starling does. It's just a pure technology play. So it's beautiful because it's very scalable. It works for their partners. It works for them to drive revenue. And so I think it's, super exciting to see them scale out. And Sam Everington is brilliant. So it makes completely sense that they're being highly successful at this work. So it's exciting.
That was so good. I'm so glad you were here to talk about that.
Yeah.
All right. And finally, something a bit more serious, actually, but timely this week to end on. As Valentine's Day approaches, various fintechs and banks have been warning their customers about romance scams. For instance, Charlie, a banking platform for Americans 62 plus, has revealed the top celebrity fraudsters impersonated in romance scams targeting other adults. Keanu Reeves and Jason Momoa topped the list, followed by Sandra Bullock, Ryan Reynolds, and Tom Selleck. Romance scams generally are on the rise, with scammers exploiting loneliness and isolation among often, although not always, older generations to build fake emotional connections and steal money. At this time of year, it's important to help consumers protect their finances and hearts. Veronica, I'm going to come to you first on this because I think you made a really important point in one of the earlier stories about linking mental health and money and personal finance. It's an important sort of call out, isn't it?
Yeah, I think it is. I thought the story was really, really interesting. The moment they mentioned Tom Selleck, it was like, wow, that mustache has kept us captivated for how many generations now. But I joke, but it is actually really telling because a lot of these scammers they're the really clever ones. What they do is they really think about who's their audience, who is their target, and then they prey on those vulnerabilities. So because this comes from Charlie, which is going to look at the boomer generation, the 62 plus. This is a generation that actually really put a lot of faith into celebrities. It's a generation that very much grew up with these sort of A-list celebrities who really became, culture icons and barons and standard bearers for and product promoters as well. We're talking about a generation that is also approaching retirement, is really going through a loneliness epidemic as well. Whereas the younger generation, might be looking more towards social media or, I'm a millennial. We had the Tinder swindler, right? Everyone has their vulnerabilities, and the really clever scammers know exactly who they are talking to. So I think it's really important to, really take a look at what Charlie are doing, but also how to have a better duty of care to this particular, about to retire or retiring demographic, how to enhance their sort of financial literacy, AI and tech literacy as well. But I think also tackling loneliness and community connection is really important as well. So my advice might be, yes, let's see where as tech platforms we can enhance our educational content and community outreach, but also call your moms more frequently, like actually just engage with people in your community, because it is a very human vulnerability that scammers really go after.
Just to dive in there, I saw the most fascinating headline on this exact topic the other day, which was a woman in France who was scammed out of $855,000, or like 830,000 euros, to Brad Pitt. And it was like AI generated photos of him in a hospital bed being like, please, like, I need money. And I was just thinking from like a British perspective, like with consumer duty, I know a lot of banks think that it's quite onerous, but with the rising number of scams and this poor woman, like, I don't know, it's hard to relate to, because I think, it is a different generation though, and their kind of ability sometimes to weave through what's AI generated and what's not. And some of them get very, very good, like the AI generated like voices that sound like their own children or family or relatives to scam them out of money. Be like, I'm in this like an emergency. I need you to send me money right away. It can be very provocative. So I think it's just happening, and it's happening at such a scale now that I think that regulation and that kind of sense of, duty that we have to customers to try to help them understand. But then I think to Veronica's point, just as friends and family, how to like help and support, our friends and family in this as well, I think is a fair point too.
And actually, Megan, maybe going a little bit wider, just beyond friends and family, because one of the things that stood out for me from the story that you mentioned was when that story became public, the victim got a lot of sort of like victim shaming on social media, and a lot of like unkind things that were said, like, oh my God, like, how could you fall for it? Like, blah, blah, blah. So I think just generally, maybe we all just need to be a little bit more understanding, a little kinder to each other.
Yeah, because it's really sad. Like that woman was clearly trying. Well, I mean, she's clearly trying to help, but I think she also left her husband for him. So I think that's probably where a little bit of it got in. I think it was like also like a bit of an affair with the AI Brad. So I mean, there's a nuance to each of these stories, I suppose. But I think you're right. Generally speaking, a lot of them come from a place of good intention. And so even though people are being scammed out of money, it's usually because they're scared, they're trying to protect a loved one, they think someone genuinely needs help, or they're trying to like, there's the ones that impersonate the government for like national insurance, something or other for a while there. It's like they're just trying to do the right thing, and it's just hard for them to discern. So I think you're right, giving people a little bit of grace to be like, it's a good intent. It's just sometimes challenging for people to discern what's real and what's not. And technology is just, rapidly increasing in its ability to like confuse people effectively.
Yeah, I think it's a pretty harsh indictment of society how many people are kind of this is the only way that they feel that they can find that connection. Just it's not quite a romance scam, but just as a sort of example that flips this on its head. I got a message the other day that was said, "Hi, this is Mum. It's my new number. Can you call me?" And instantly I rang the number I have for my mum, and I was like, just checking, because the other way around, the point about the technical literacy, like my mum is really quite technically literate, like she's smartphone, she uses online banking, all that kind of thing. But I could believe that she'd got a new number and not realize that that's what happened. Like I could believe I could do it, to be honest with you. Like, it didn't surprise me. So I think that they can also play on all sorts of relationships and all sorts. It doesn't have to be a romantic relationship. It doesn't have to be the vulnerable. It's kind of where can they hit your vulnerabilities, even if you don't fall into that broader, more vulnerable category. I think it's quite terrifying, although I also think that if I was told that Keanu Reeves was interested in talking to me, I might pick up the phone. So, and I've been doing this for a very long time.
We can all dream, Sarah.
Yeah, we can dream. We can dream. Look, Ryan Reynolds owns a house in Wales, so there's possibilities.
True.
Good to know. I do just want to jump on quickly what you said as well is with the romance scams in particular. Like I do think we have to understand when we have empathy for the victims of these scams is actually how they work. You see sensationalized headlines, but actually what these scammers are doing And they're using AI, they're using automated messaging to make their work so much faster and efficient here. But what they're doing is they are sending unsolicited messages on social media and casting the widest net possible, just hoping that you respond. They might be sending the same message to you and 100,000 other people, and it's, "Hey, it's mom. Can you call me back?" And that's going to start a funnel of those people who call you back. Or with the romance scams, it's "Hey, I noticed your photograph. You look really lovely." And then as soon as you engage with that and just comment like or whatever with that little bit of social media engagement, then you get a direct message, and it's "Hey, I'm so and so. I wanted to comment on your social media. I'd love to message you this and that." And and then it's a few messages down the road, it's, "By the way, what have you done over Christmas? Oh, you didn't have anyone to spend Christmas with. Well, me either." And over the course of weeks and months, it's developing these synthetic, but very real, emotional engagements. We're all human. Any single one of us could find ourselves in that situation. Some of us who are listening might have had that situation, might have had a loved one go through it, because the way that these scams work is they're extremely clever in who they target and how they communicate very strategically. It could easily be like in the form of this conversation that we're having right now in the podcast, and in the course of an hour, you've bought a product you had no idea you swiped your credit card for.
Yeah, and look, the really scary thing is it's literally happening on an industrial scale, and that wouldn't be the case if it wasn't super lucrative. So we're all vulnerable, and I think stories like this that bring it to the fore really are worthwhile and important. All right, well, look, that wraps up this week's Fintech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about you guys and your companies? Veronica, let's start with you.
Yeah, you can find me on LinkedIn, Veronica Maria Gleb.
Amazing. Megan, how about you?
Yeah, LinkedIn at Megan Kaywood Cooper. You can also find my company Kaywood on there as well, or at kaywood.io.
Amazing. Sarah, how about you?
You can find me on LinkedIn. You can find Fintech Wales online. And actually, just a little bit of a plug, next week, or rather the next 2 weeks, is Wales Week in London. So I'll be down in London shouting about all the wonderful things we have in Wales and all the wonderful Welsh fintechs we have. So if anybody wants to chat about Wales and Welsh fintech, then please do drop me a line on LinkedIn, because I'll be hanging around London for the next couple of weeks.
I love that, Sarah. That's really great. All right. And as for me, you can find me, Ross Gallagher on LinkedIn or 11fs.com. Thank you so much for listening to today's Fintech Insider. If you like what you heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast with a colleague or friend? As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider, or email podcasts@11fs.com. Thanks again, and goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.